Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 21st of February. I'm Daniel Lam, your host for the podcast. Right after the Chinese New Year public holidays, I took part in the Hong Kong SAR Standard Time Control Chess Championship for 5 grueling consecutive days. I did not manage to retain my title, making a number of inexplicable errors. And I was very lucky to be able to tie for second to fifth places, with the other 4 of the top 5 finishers all below the age of 15. Now, refocusing back into finance. Good times is always great to enjoy, but we have to respect risk. Year to date, global equities have been strong, but lately there has been some volatility due to concerns that disinflation may be over. It was because of the hotter than expected US inflation report last week and leading indicators pointing to a near-term pickup in growth momentum in the US, Europe, and in the UK. However, it is too soon to conclude that this is a reversal of the ongoing disinflationary trend. The counterpoint to the US inflation figure was the softer than expected US retail sales number. Now, the control group retail sales, which is considered a more precise measure of consumption, contracted 0.4% month on month. Some of the weakness can be attributed to a moderation in sales following December's holidays, falling goods prices, and bad weather. Nonetheless, slowing consumption data supports underlying weakness in the job market, seen in the continued decline in average hours worked. So on balance, the latest series of US inflation, consumption, and job market indicators are providing mixed messages. The Fed will likely need more convincing signs of a cooling in economic activity and continued disinflation before it considers cutting rates. The Fed's meeting minutes and PMI data later this week will be closely monitored. So how should investors be positioning their portfolio? Well, we're maintaining our overweight to global equities with a preference for US and Japan, given continued resilience in economic activity and corporate earnings, while staying overweight on developed market government bonds to capture attractive yields. Now, for those investors who may be concerned about a revival in inflation, they may consider adding some short-term US inflation protected bonds. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.